Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello, and welcome back to the podcast. Thank you very much for being here. A lot of you know that I absolutely do not like universal life and variable universal life and index universal life. And in Nelson's book, he talks about why we should not be using universal life because it is nothing more than renewable term insurance. However, today I have lots of examples. I have been sharing these examples on TikTok. And so I just want to make sure that those of you who are not out in TikTok land are able to see these. And so this is probably a podcast where you're going to want to go to YouTube and you are going to want to watch the video portion of this. And if you are looking for me on YouTube, just type in Mary Jo Irmen and you will find me. And then, of course, while you're there, please subscribe. That would be awesome. So let's get into, I have a number of examples of why these are not good. And so this should be able to help you guys when you have, or if you have a policy that does not say whole life. Call your agent, call the insurance company, and ask for an in-force illustration. INFORCE illustration. And that in-force illustration is going to show you what is happening inside the policy, what the projections are going to be, all that good stuff. And so I'm going to share those with you today so that you can kind of look at yours. I'm always happy to look at them and let you know if it's good or if it's bad. I will tell you, in 13 years of doing this, I just a couple of weeks ago saw my third decent, not good, but decent universal life in 13 years. So there are very, very few of them that are decent. So let me show you exactly what I am talking about. So you will see on this illustration, this is a variable universal life. You will see on this illustration that we have a 4% return, but a net return of 3.43. And that is because there are expenses. You will also see in this column that says COI and contract charges, that those are on this column in particular, those are the max amounts that they can charge you. On the assumed current costs, this is what they are charging right now. This is the max of what they can charge. It says right there, maximum costs. This particular individual is 55 years old. And so this is what their policy's projections are. If this policy makes a 4% return every year, if it makes, even right here, you can see this is a hypothetical rate. There is not a guarantee in a variable universal life. And so we're paying $1,800 a year in premium. And so we have a cost of insurance just this year is $839. They could charge $2,257. Now you'll see if they can charge the max amount, this policy is going to collapse when he's 65 years old. If they make 4% every single year and keep the charges the same, then we are going to go much longer than 88 years. You'll see that we are actually going to go into year 100. However, in order to get to year 100, look at what happens, right? We're paying $1,800 a year, but at age 94, looky there. Premium went from $1,800 to $5,800. No cash surrender value. death benefit is $100,000. So at 95, it goes from 5,800 to 18,000. Then 21,000, then 23,000, 25, 27, $30,000 for $100,000 of death benefit. Nobody's going to pay that. Everybody knows that. But look at what happens to the cost of insurance. This is on the current cost side. This is what they're projecting the cost of insurance is. And we could see on that last chart that every single year cost of insurance goes up because it is renewable term. So at some point at age 98, you can see that the premium is $25,000 and the cost of insurance is $25,000. All we're paying for is cost of insurance. Well, this person will have paid more money in premium than they would have actually gotten in death benefit. So why would we keep this policy? This is actually best case scenario. This is if we have the same cost of insurance we do today and we have a 4% return, which is actually a really good figure. It's 4%. That's the average of what the markets do. And this thing is still not going to be good enough. So we have to beat the market in this situation. This is crazy. All we're doing is rebuying term insurance. Okay. So let's look though, in these variable universal life policies, there is not a guaranteed option. All these are saying is that you are guaranteed never to go below zero. Well, let's look at what that is. Some people call that people in the IUL world call that a floor. People in the VUL world call that a guarantee. You're never going to go below zero. If the market crashes, you will never have to worry about that. Okay, well, let's just take a look to see what that looks like. Here is the 0%. You can see hypothetical rate of return 0%. So if the market crashes, you can never go below zero. Oh, but look, what does this mean? A negative 0.57% net return? Why would it be negative? Because we have these costs of insurance and these charges on the outside of the policy. So yes, in fact, it can go zero. So when this just drives me crazy when life insurance agents say, oh, well, you're never going to lose money because you can never go below zero. Yes, you can. It's right there in writing. And so now if it's a 0% return, this policy is going to collapse at 88. The chances of this happening are almost nil. So don't be alarmed by the fact that, oh my God, I could make 0%. Yes, you could. But it's not going to happen every year. It's just going to be when the market takes a downturn. Like last year, you probably made a negative return. It wasn't as negative as the market, but it was still negative because if you have a variable universal life, it's going to be 0%. The market went below and it was negative. All right, so let's look at another one that is also a universal life. It's not a variable universal life, but it is a flexible premium paying. And so I see a lot of those flexible premium universal life type stuff. So let's look at that and see what that looks like. Flexible premium universal life. This is a 4% guarantee. So a typical universal life will have a guarantee. Okay? A variable has no guarantee. The non-guaranteed is with current charges. The guaranteed is with max charges. So we can see that this individual is 79 years old. If we have a non-guaranteed side where we don't increase the cost of insurance, then this policy is going to be okay for another year, maybe two. When I talked to this client, the fees and charges were already so much every month that I don't even think it'll make it till the end of the year. But if it does, this is where we're at. Now, I asked these exact same clients, I said, well, ask the insurance company to run this illustration so that we can see exactly what is going to how much premium do we have to pay to keep this thing alive? And so this is what they came back with, which is $83.49.71. That is what the insured need, or the policy owner who doesn't happen to be the insured, but what the policy owner needs to pay every single year in order to keep this $136,000 a death benefit. Okay, if you notice, this is a little bit ironic because they're saying it's $83.49 on the non-guaranteed side, as if the current charges are never going to go up, right? And we know they can charge more, but they didn't even put anything on the guaranteed side, which makes me believe that $8,300 is not even enough to keep this alive for another year if they decide to charge the max amount, which ideally, let's hope that they don't. But this is telling me there's got to be a middle ground. So if we charge more on the non-guaranteed side with current charges, if we charge a little bit more than that, then that $8,300 is not going to be enough. Maybe it should be $10,000 or $11,000. And I actually asked them to go to age 100 and they came back with 95. This also happens a lot where we want an illustration to go to age 100, but I'm only ever seeing 95. And it actually collapses at 94, not 95. So if the policy does maybe only go to age 95, we didn't even get to 95. We ran out of money at 95. And so the lack of following instructions is absolutely crazy to me because I don't understand why we don't have anything over here on the guaranteed side, because that is worst case scenario, but yet they're giving us best case scenario. Super, super annoying. Now, here is another universal life product. And this one was a little more interesting and a little more fun to look at because of the fact that this policy was issued when this person was a child. Okay. And now we can really see what has been happening inside of this policy because it is super old. And people don't typically have their original illustrations from when their policy was issued. But this one, the client is 39 and the age of the policy is 39. Again, a universal life. So we have a guaranteed and a non-guaranteed. Not variable universal, not indexed, but it is universal. So the guaranteed, again, that is the max amount we can charge them. The non-guaranteed is what they're charging today. Interest rate is 4% over here, 4.5% over here. The interesting part of what I liked about this illustration is that we can see the cost and the charges. So cost of insurance is what COI stands for, and contract charges. So we can see that these contract charges, even on the non-guaranteed side, are going to start to be more expensive at age 57 than what he's paying in premium of $102 a year. And the chances are it's not going to ever be those max charges. However, we can see $102 a year is not going to take us forever because these charges already get astronomical when you are in your late 50s to early 60s. Now, this is typically when we see these policies really start to go bad is when you turn 60 to 65. Because think about it, when you buy term insurance at 65, it gets extremely costly, right? The other interesting thing is this is the in-force illustration. The client has the original illustration that was given to his mom and dad when they bought this policy. This policy is about $10,000 off of where it should be. So instead of having $3,000 of cash value, there really should be like $13,000 of cash value in here. So this is not good. Not good at all, but a great example of exactly what happens. Another great example of what happens inside of these policies. But let's keep looking, because if we continue to go into his policy, everything is going to be okay. until he's 68 on the guaranteed side. Max charges, that's worst case scenario. But if we look at the non-guaranteed side, everything's okay till he's 76. But then do you see how the premium starts to increase? So in order to even keep this little bit of death benefit alive that we have to pay this extra premium, or there's no death benefit. You can see at age 78, there is not a death benefit unless he pays this extra premium. So again, a policy we bought when somebody was a baby, and they're not going to even have a policy past 77 years old. Well, this person's only 39. Chances are they are going to live well past 77 years old. So we've put all this money in and we don't have anything to show for it. What? Why? There is just everything in these policies is tied to the market. The cost of insurance was not there forever, right? Or it wasn't set forever. It is a variable amount and it continues to go up. Here is another one on an older individual. And again, another one that's not good, and it looks like it's going to collapse any second. But this is also a 4% rate of return. This is a flexible premium universal life. I do not have the guaranteed side, I don't believe, but this is the non-guaranteed side. So we can see that premium is $15,000 a year. We are only going to be able to go to 94 years old, at which point we are not going to have anything. Death benefit is $200,000. What I found interesting on this one was that they sent another portion of this along, which is showing us the fees and charges inside of this thing. So if we look, I like how they say this is what we deduct, because a lot of people don't, how they present fees and charges is very different within every company, and it doesn't ultimately matter what the company is. But what we deduct is non-guaranteed premium load, okay? We have cost of insurance, and then we have administration and rider charges. So a lot of times this is just administration charges. And then here they have the non-guaranteed coverage charge. And there's nothing in here. So obviously that's a rider and it's probably not on there. I don't know what that would be for, honestly. I'm assuming some sort of a rider. But they add all these charges up. So total charges is $129,000. But the premium over the same period of time is $110,000. So we are going to pay $129,000 for a $200,000 death benefit, but the charges were $129,000, but the premium was $110,000. Like, those numbers just don't make sense, right? Because we've got more charges than we do premium outlay. And so why are we not paying more premium? And it's minor administration charges of $420,000. That's minor. Premium load and the cost of insurance charges, those two things are actually in whole life as well. But inside of whole life, they're built into the premium. It's already packaged in. Where you can see in a universal life product, it's on the outside and they haven't accounted for it correctly or accounted for some of it at all. So if we're not accounting for it, then we haven't built it into the premium and these charges can be changed. Inside of whole life, they can't be changed. It just is what it is. But it's already, because cost of insurance is there. That is the cost to buy death benefit. That's there on any policy. Premium load is there on any policy. What the difference is how that policy is constructed, right? It's like saying, here's your entire sandwich. So with whole life, this is maybe a good analogy. I don't know. We'll see if it makes sense to you guys. But with whole life, they're like, here's your entire sandwich. Your sandwich is $5. With universal life, they're like, hey, here's your bread. If you want meat, you have to pay extra. If you want lettuce, you have to pay extra. You want some vegetables on there? Oh, that's extra too. And oh, if we're out of lettuce, I'm sorry, we're gonna, we can't put that on there. Like, we have these add-ons that we don't really know what the cost is, because if you wanted lettuce today, it might be $1. But if you want lettuce tomorrow, that lettuce may have gone up in cost. And so maybe it's $1.25. So if you're going to add it, you should probably add it now. Where in whole life, we know what that is because it's whatever it costs today. It's packaged in. And so many people think that this universal life is great because it's cheaper. Well, it's only cheaper because they didn't figure all those costs and those fees correctly. And then we went to the market and there was a difference in return. And I've explained all this stuff a million times. So you can go back to those podcasts if you want all of that stuff. But I just really wanted to show you, this is what I see. This stuff that I've showed you is just what I've had in the last 2 weeks. That's not stuff I've had over the last 13 years. That's just the last 2 weeks. And some of those all came in one day. And so there's so much of this crappy universal life out there. And now we start to throw in IUL as if it's better. So we started universal life where there's some guarantees, and that's not working. Clearly, you saw that. Then we threw in some variable universal life, which is variable. It's actually worse than universal life. You saw that. And now we came up with an indexed UL, which I have not seen an indexed UL. I have statements of all the expenses and charges, but I do not have an actual in-force illustration to show you yet. And so those are actually worse than the VULs and the ULs. And so can it get any worse than what we just saw? Yes, it actually can get worse than what we just saw. And so if you have those things, please, please, please call your agent, call the insurance company, ask for an in-force illustration. Get that in-force illustration, send it to me if you want, whatever. Bring it to our meeting so that we can talk about it. If it's good, I want you to keep it. I do not want you canceling insurance. If it's bad, we're going to talk about how do we save it? What do we do with it? There's other options of what we can do, but which option is the right one is basically what it comes down to. So please let me know if you guys have questions, comments, concerns. Be on the lookout for these. Now, I hope that helps you understand a little bit what you're looking for. If you are wanting to go to YouTube to watch this, Mary Jo Irmen on YouTube, subscribe, and then you'll get notifications. I don't do a lot of stuff with numbers, but if I do, you're going to want to be subscribed to the YouTube channel. All right. If you guys are in and around Arkansas, I will be at the Ozark Beef Initiative, and that is May 6th. So you can go to beefinitiative.com, grab your tickets there. If you are in and around Arkansas and you want to come to that, you can grab tickets there. I will be talking about farming. So let me know if you need me, Mary Jo at withoutthebank.com. Otherwise, grab your book and set up your appointment. Talk to you soon.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.